Hey, Mikey, what's happening, man?
What's going on?
Just living the dream. I try to put this like finance question up here as like my background, but I don't know why it's making me look so like hologrammy, but I don't know how to even turn it off here. So I'm just
Whatever.
gonna roll with
Let's run with it.
it.
As I was live, basically so I'm in Sacramento right now for a conference for basically every city in California, and
Yeah.
yeah, I'm a council member for my city, so that's kind of context for it. And one
Yeah.
of the rooms was talking about basically the housing crisis and all the
Mm.
state laws that are changing to try to solve the housing shortage. And so before we jumped on, basically the question I asked everyone was, what would you do to solve this problem? We know what the state's doing, at least if you live in California, but that was the question I presented is what would you do to solve the housing crisis?
Gosh, that's such a good one, man. I mean, it's I feel like it's kind of like the whole like not in my backyard type thing with trying to increase housing and everyone wants it, but nobody wants it near them. So I feel like there's going to be a lot of compromise and there's going to be a lot of happy and a lot of angry people regardless of what decision you make. But boy, it's I feel like probably taking down some of the red tape too, encouraging construction workers, maybe giving some type of subsidy or tax break on trying to get a little bit more supply out there because that's really the issue, right? It's a supply issue.
Yeah, yeah, you're talking like an entrepreneur.
Are we getting there? Are we knocking on the door?
No, that's very in line with my view. I think like basically what the state's ultimately trying to do, and you kind of touched on it, was like the NIMBY movement, right? The not in my backyard.
Yeah.
And there's a part of it where I understand. Like I understand, moving to an area and falling in love with it and not wanting it to change. I totally get that. I
Yeah.
understand building something and changing the character, potentially adding traffic, potentially adding crime, just you increase density. Those are challenges that come with it, right? So I understand that side. But at the end of the day, people were getting elected to city council to stop growth. And so,
Yeah.
population would increase and we would need more housing, and that was the block. And so what the state's doing is saying, okay, you guys are no longer going to have the power. We are going to basically go around you and stop your ability to stop development. And now it's just everyone's getting hit and inundated with it. But I tend to agree with you. Like if you want something, if you want more people to put dollars in a certain area, I think you incentivize them or influence their behavior through incentives, whether that's tax incentives or however you go about. I think it's removing regulation or increasing the speed to build something and gives people an incentive to invest there, right? I mean, you're seeing it with energy right now. We've seen this throughout history. I just think they need to do it
Right.
with housing.
What do you think kind of is going to be the takeaway then? Are they actually going to try implementing something to that degree?
Well, the hard part is California. In California is very. Where do you live? Where's home base for you?
Marina Del Rey,
Oh, you're in California.
Venice Beach.
Yeah. Okay. So, uh, our state is very difficult to build. Period. Right. It
Yep.
is not easy to build here. We have environmental like CEQA is a kind of a big part of it, and there's certain uh, there's a lot of barriers that I don't think are ever going to go away. So I'm not totally sure that we're going to actually be able to increase the speed in which we build. So I don't know. My takeaway is we're going to see this problem for the next 40, 50 plus years. I don't think it's going to get solved soon.
Jeez. So then, what are some of the second, third, fourth order effects here? Because I'm imagining that housing is just going to continue going bonkers then almost from this like I don't want to say, but like artificial market that we've created.
Right. Yeah. I'm that I think is my biggest concern is that California, and I don't think it stops with California. So that would be my biggest fear is that California becomes a state that is basically not available for the majority of people. It can't buy or rent here. And so people start moving out, and if that spreads further, I mean, it's already not a good issue if it's here, but if it spreads out, that's not good. I think, like, I don't know. Let me ask you. You follow the markets. You're an advisor. You're working with behaviors. What do you think the impacts are to never allowing a market to correct? Because in a lot of cases, we're seeing it in many counties with real estate, but moving into the financial markets, like, where do you think the balance is from letting banks or entities fail, which is going to be very destructive, and a lot of people are going to basically feel pain? How do we navigate through that? When is there too much government involvement? And
It's so
Anthony
tough, man.
Gomer, that's a phenomenal question. What happens when baby boomers are gone? That's a big part of this. So I'm glad you asked that. But what do you think, Colin?
Gosh, I mean, you're asking the $1 million question, right? And I think that's what a lot of people were. I mean, like, Drunken Miller, who is, one of the few hedge fund managers I actually like kind of follow, because most of those folks just simply underperform index funds and like to charge high fees for it. But he's been calling for a crash really for a long time, and we just keep pumping more money into the system. We're up to 33 trillion in debt now, and I think you're just going to continue to encourage reckless and risky behavior. So, it's kind of like the hair of the dog, like, right? You're hungover. So what do you do to fix it? You drink more. And, Huberman's going to tell you that the only way to get over a hangover is to stop drinking. It's going to take time. That is the only thing. Everyone's got a supplement, a pill. It takes time. Your body has to metabolize it, and the economy has to metabolize all of this slush money kind of propping up markets. And I think we did have kind of a healthy correction, especially in the tech industry in 2022. I have a lot of clients who are in that space, being in Silicon Valley Beach, near Playa Vista, the Google, Yahoo, like there's a bunch of companies that have home bases there. And there was layoffs, man, and people were feeling it. They're feeling it in public markets, private markets, but I feel like real estate didn't really have it as much. I mean, you're watching probably prices plateau.
Right.
And maybe the best world is that we just watch this plateau. Like if you look at the Bob Shiller housing index, it's been growing, single family homes grow at about 4% per year on average across the country. And from 2020 to 2022, we saw it go up 20%. So, I mean, that's like literally a 5-year advance. We could probably see housing stay flat for 3 more years, 4 more years, and that'd probably be kind of healthy. I don't know.
Right. Yeah. Yeah. It's so I mean, office is a little bit different, but what we've seen in commercial is cap rates have moved, right? Like cap rates have softened, which for anyone who doesn't know how cap rates work, to keep it very simple, if you were to buy a multifamily apartment at a 5% capitalization rate, what that basically means is if you bought the thing in cash, no leverage, you can expect a 5% return each year. It doesn't include appreciation, right? It's also a metric on how you get to the valuation of a property. And if cap rates go up, the value of your property goes down. If cap rates go down, the value goes up, right? So we've
Like a
seen a
bond.
softening, which means the value should have decreased. But the challenge is because of all the inflation meant that your net operating income increased. And so you saw a value which should have been, prices going down, stayed flat because of how the levers work. And so that one's an interesting one. We'll see we'll see the final outcome of that. Single family, it's, in the markets that aren't undersupplied, I think you've seen the price correction. Depending on how bad this union strike is, that might make things worse for longer, right? You're almost like we're racing the clock here, right? Like, how long until the Fed brings rates down, and are you in a position to wait it out ultimately? And so we'll see how it goes.
What do you think about
Yeah,
this higher interest rate
Nicolas
environment?
Cage. Oh my gosh, are you kidding? That's too
Is
good.
he in here?
Say that again.
I can't see, this is another terrible UX piece. I can only see the people following me. So I have
Oh,
17
bummer.
followers in here
Oh,
and I can
bummer.
only see their comments and I can't see yours.
Oh, bummer. Debbie just hit me with, when did Nicolas Cage learn so much about money? That's too good. All right. What did you say about interest rates? What do I think about interest rates?
That's hilarious. She must have gone back and forth. Did you see her comment about MPI?
No,
Or
I didn't see that.
she asked me what my index universal life is worth today, just because she knows that I make fun of that product quite a bit. So she's just poking fun.
Not an insurance guy, huh?
No,
A true
no.
financial advisor.
Yeah. No, not one of these fake ones. I only sell advice. So there's no products. I only charge flat fees. So I'm
It's
not
more like on
even
the financial planning side.
just
Is
on the
that what it would
planning
be?
side. I mean, I do investment management for clients,
Right.
but I just charge fees based on the complexity. There's no insurance sales. Um, just we're
Got it.
just giving advice here.
Creative Angela says we have nice hair. Thank you. Colin's younger than me, so I'm glad I could hang with the youngster. Uh,
Hey, you're looking great, man. You're looking great.
what did you say about interest rates?
I was gonna say, what do you think about this environment? Like, I almost don't hate it that savers are getting rewarded now. Like, I like getting 5% on my FDIC insured money market account. Now it does come with, the once again, if you already own a home or something, like you're
Right.
probably more in that camp. You're locked in with your low interest rate, et cetera. But
Right.
um, it's I don't know. What do you think? This is kind of a little bit more of like the historical norm, and I
Right.
almost kind of like that. There's less silliness. Like I feel like when cash was free, everybody wanted to buy an internet coin. Everybody wanted to, do this really silly, aggressive stuff, project funding projects. The That was like the whole crypto ape era, and
Right.
now it just feels like okay, we're kind of
Right.
back to normal here. We took a haircut on tech. I don't know. It just feels a little healthier.
Yeah, I would say what I would add to it. If prices moved the way I think they should have when rates increased the at
Yeah.
least percentage they did, I'd feel completely aligned with what you just said. My concern is when the markets don't move to that tool. I mean, that's basically the tool the Fed has, right? And I
Right.
think it's concerning that looking at real estate specifically, real estate didn't correct the way it should have by raising rates that significantly. Don't
Right.
love that. Um, I think the market should have been impacted more than it was. Uh, but I would say this: I don't. I still think there's too much money in the system. I don't think it's interest rates that is
Yeah.
the challenge right now. It's all the money we printed and the supply issues. It was all of that that led to this, and I don't think we're
Hmm.
through that. I really don't. I don't think we're through the inflation issue. I think interest rates are going to stay up longer than people think. I personally think the economy is worse than it's stated. I look at the
Hmm.
data the same way everyone else does. I just what I'm seeing with business and talking to people, it seems like people are feeling pain more than it's represented. I don't know if that's a hunch. The data does not support what I'm saying. The data makes the economy look better than that. So
Right.
we'll see. But to your point about interest rates increasing so that you can actually make yield, yeah, I like that 100%. Like, my parents always
Yeah.
told me about the days where they could put money in a money market and make whatever 10 plus percent.
Yeah.
That's great. So we'll see. I mean, we'll see how this all shakes out. That's for sure. But I think the challenge is everybody's looking at what the Fed's saying they're going to do. If the Fed's
Yeah.
saying, and what's the Fed's outlook? That the end of this year will land somewhere around 5%. Next year will land somewhere around what, four, 3.5 to four. And then 2025, end of 2025 expectation, it's going to be somewhere around three, right? When
Yeah.
when that's the expectation, I don't think people make the same decisions they would if that wasn't what was communicated. Like, think about if it was communicated, yeah, interest rates are up, they're going to be here for the next 5 years. We're not going back to cheap money, right? I think there'd be
Right.
more reservation or more, how would you say this? Everybody would be pulling back more on their spending. I don't think that's happening. I think everybody's like, shit, we'll wait this thing 2 years. We're good. This will be a blip and we'll get back to it. I don't know. We'll
Right.
see.
Gosh, it's going to be an interesting one. Totally pivoting, switching gears for a second. Was curious, do you know anyone like on the Nitro Circus
Yeah.
train, like
Yeah.
all those guys from like, the good old days?
Yeah. Oh yeah. Yeah. I
Who
totally do.
are you buddies with Travis?
I'm not buddies with him. We used to cross paths a lot when I was skating,
Okay.
but we never became bros. Just like, hey, what's up? How are you? We'd see each other at
Okay.
events. I know a lot of the guys that created at least the show or the production element to Nitro Circus.
Okay. I had to ask, I'm from the motocross world and was really, really into it in my younger days. Now I just kind of trail ride and like to follow it, but they've like really expanded into, the biking, the skateboarding,
Yeah.
scooters. I mean, shit, they'll jump anything with wheels. And
Yep.
I
Yep.
just feel like that's just so awesome and a little bit up your alley because I
Yeah.
definitely am a fan of yours on
Those guys are gnarly.
the
Like
pre-investing
they're
side.
so much gnarlier than skaters, I think.
Oh,
Like
they're gnarly.
yeah, yeah, that's right. So what are you seeing? What are you seeing with your clients? What do you think I mean, what's your takeaway from this moment?
Um, I guess a few different things. It's always going to come back to when I'm working with someone, I go on timelines. So I actually kind of break it down into what I call stair steps. And if you need money in the next 1 to 2 years, if you need money in the next 3 to 7 years, and if you don't need money for, 10 years plus, that's pretty much going to tell us what percentage of equity versus bond versus maybe cash or high yield. And you just cannot predict the market. I mean, we
Right.
can, you throw 10 economists in the room, you're going to get 10 different opinions and they'll all be wrong.
That's right. That's
It's worse than, astrophysics, or what's your sign?
right.
That's almost to the extent. Now that doesn't mean you can't make educated decisions and, try to place your bets. And especially for you and I, small business owners, like, you can put your blood, sweat, and tears into something, outperform the market. Like, do I expect my small business to grow faster than the market? Like, sure, you can kind of go into like that, like where to grow wealth faster question. But from a where do I put my capital? Timelines, baby. And if you need money in the next 1 to 2 years, get it into your high yield savings, collect your 4.5%. You're probably not making any real money net of inflation, but at least it's going to be there when you need it. And stay diversified on your long-term accounts. Get into your index funds, extremely low cost, extremely diversified. And historically, you've doubled your money every 8 to 10 years. And if you can get 3, 4 doublings over your lifetime, you know, that's pretty tough to ask for any more if you're not doing anything special and creating new value by
Right.
yourself.
Right. 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 I think that's a very good way of looking at it, and it's very well articulated. Yeah. So you mentioned that some of your clients are in tech. Does that mean you
Mhm.
are one of the rare advisors that put clients in alts?
No, I'm not really in alts too much.
Okay.
It's I serve high income earners because they just have a lot of tax issues and that's kind of where I've pivoted a little bit from traditional wealth management where usually they charge 1% on $1 million or something and they're
Right.
looking for retirees. I'm
Right.
kind of looking for those 20, 30, 40, 50 year olds with high incomes, they have incentive stock options, they have restricted stock units, they have employee stock pension purchase plans, ESPP plans, and like they're like, what do I do with all of this equity compensation? I'm trying to buy a house, I'm paying off student loans, like I just got irons in the fire,
Right.
and I need someone to vent to and help me organize this stuff and make some good tax decisions.
Right. Right. So
So,
I feel like I know your answer, but I just want to ask it for anybody listening. It's
yeah.
real easy to get focused on the tax side of things, right? Tax planning and trying to capture loss or depreciation, etc. Uh, do you think it's better to be focused on the tax saving side or focused on return, or is it a balance game?
So I'm never going to let the tax tail wag the dog. So for example, if you have a ton of stock in a really concentrated position, like one stock because it just exploded, you already hit the lottery once or twice. Like, don't keep it in there. Probably you should be diversifying. And then once again, that starts to kind of step into the, well, you shouldn't, I diversify from my small business, shouldn't use, and it's tough. That is tough, but I'm guessing that you don't put 100% of your money back into the business every single year with zero outside investment. And I think that's kind of where I usually lean. Now, from a planning side, though, you can be slightly strategic and say, all right, should I go traditional versus Roth 401k IRA? Should I be invested into my HSA? Should I be, there's different avenues in which you can do this reasonably strategic, like maybe hold less bonds in your brokerage account, keep your bonds in your pre-tax account, just so you're not incurring all of these 1099s every year. So we can be a little bit strategic that way. Maybe it makes sense when, your Bitcoin is down or something, or a stock is down, you can sell it, create a loss, put that loss in your back pocket. And then when things go up, you can sell and kind of tax loss harvest, as they call it. So there's like things that you can do, but, they're going to get you coming in or they're going to get you going out
Yeah.
on the tax
Yeah.
side. So
Yeah.
it's that's not where I like brag that like I'm not going on TikTok and being like, oh, you can like save X amount of, I mean, there's so much crappy advice out there.
Yeah. Buy a car over 6,000 pounds. Anthony Montgomery says tax averse minds create bad financial decisions. Yeah. The my outlook's actually similar. I think you always make decisions, at least from an investment standpoint, based on risk, return, capacity, goals, etc. And then throughout that, if you can find ways to create some tax incentive or some tax deferral, great. But not doing not making the decision that results in the best investment decision because you're focusing too much on the tax side. I think that I would totally agree with Anthony. It jams people up.
Yep. Unless your tax rate is 100%, go grow your money.
Yeah, that's right. That's right. Yep, that's right. And in some, in real estate, like the big one, it's the 1031 exchange, right? That's or just the depreciation aspect to offset maybe your taxable income or to push it out. When we sell, this last year we sold two apartments, and so we had taxable events, right? We didn't exchange them, and we had so many investors that were like, "I have to pay taxes on this? Like, what the
Yeah.
F?" You're like, if you have to pay taxes, that's usually a good thing. Usually a good thing. Like you just have money put in your pocket, like, yeah, we got to pay taxes. But sometimes it just doesn't line up. Like a 1031 doesn't always make sense. Are you guys billing each other for this session? Debbie, we are not. That's good. Hey, Debbie in here. Debbie's got jokes.
Oh yeah. I love that. That's
That's
so
good.
good. That could be
Uh,
maybe a tax thing. Actually
yeah,
not, because then we're just bringing Uncle Sam in as a third party here. We don't need
yeah,
that.
that's right.
Um,
So,
curious, curious, Mikey, what do you say? Because I do get clients, and this is a really tough question, especially like they're selling their current home or they want to move, and they have the super low interest rate, so they like don't want to give it up. They're thinking about renting it, but they know less than nothing about real estate, being a property manager. They don't want to be a property manager. They're going to outsource everything. But they heard on TikTok that you can just travel the world and take Instagram pictures and you just get passive income.
yeah.
What's kind of your thought to like mom and pop real estate investing, having one property?
Yeah.
I don't know.
Yeah.
Does this get a little dangerous? Should you just stick with your 401k and collect your, historical 7 to 10% annually and not F yourself?
Yeah, it's a good question. Like TikTok is phenomenal to get you thinking about something that you didn't know prior and then open up the door for you to go research it yourself, right? That's what's great about TikTok. But don't take advice on TikTok as fact, right? Like when it comes to real estate, a lot of people out here are typically selling something other than real estate. They're selling a program or they're selling something that you're going to buy. So of course, they're going to, how would you say this? Oversell, right? They're going to tell you it's easy, it's passive, you can make this much money, life is good, buy my course and check out. With real estate, like anything else somebody's selling, no, that is not the case. Real estate, even in its most passive form, is still work for you. The only way real estate is passive is if you're making a passive investment in a group like mine, where we are doing all of the work for you. We're paid for that though. Like you're compensating us to be what you don't want to be. Other than that, if you are an active investor owning an asset, it's going to be work for you. With that said, to answer your question, it depends. If you want to go out and build a real estate portfolio, yeah, this could be the start of that. You have a house with historically low interest rates that we may never see again. That could be a good time to rent that out and move on to the next, and then try to add another one and another one, etc. But it's going to take work and it's going to be a second job. If you don't want it to be a second job, and kind of getting to how you stacked the question, you've got a couple options. You can bring on a property manager. It's still going to be some work for you, but basically it'll be more of an overseeing. You'll just oversee the property manager. So maybe you'll have your weekly call with them. You'll still have to put time into it, but it'll be less time than if you were the manager yourself. You're not going to get the phone call for you to go fix the toilet or whatever, maintenance needs to be done, but you will get the phone call for you to approve, whatever the property manager has to do.
Gotcha.
Is it better to sell your house and put more into the stock market? Or that's a tough one. That I think is
Gotcha.
I don't have an answer for you on that. I think it's probably going to be more a personal decision for the individual. There's people that, like, I'll give you a personal story. This will go more on my outlook and how I got here.
Okay.
I started investing in the stock market when I was 19. That was really the first thing that I started putting money into. I wasn't making a ton of money, but the barrier to entry wasn't as high as real estate. But I always wanted to invest in real estate. My parents owned real estate. There was something about the physical asset that I could feel and touch and control, or have more control. I felt comfortable with that. There was something that I liked more about that than investing in the market. And so I've always wanted more of that asset, but that's a personal decision for me. That doesn't mean that's the case for everyone else. Real estate's a liquid, right? There's pros and cons to both. Like if I need all my money out of real estate, I can't do that right now. I have to go through the process of selling, and sometimes that means it's going to take some time.
Or a
So,
HELOC or something.
yep,
Yeah.
yep. I think though, if you're going to sell a home at with a 3% interest rate, to buy a home at 7.2, I don't know. I wouldn't do that. I would look for an alternative way of doing it. I wouldn't sell for that though.
You just described the current housing market right now.
Yeah. Oh yeah, dude. The 30-year fix at 3% is one of the key factors to the situation we're in, right? It's almost like the perfect storm. You have no housing being built past the financial crisis, right? We just have underperformed post 2008. You've got 3% interest rate. You've got, even though it's actually not as big of a footprint as it feels like, you have the rise of Airbnb. You've got institutional investors like BlackRock grabbing single family up. There's all these factors that have come together at the perfect time, and now it feels like there's just not enough out here for us to get it.
Are you guys still taking outside investors, or have you kind of limited the fund? Where are you guys at, kind of talking your own book here?
Yeah, so for our company, we have two offerings open right now where we're bringing in new investors. We typically do that when there's opportunity that our current investors can't basically fully go after. So, if,
Okay.
let's say we've got $50 million worth of opportunity, and our current investor base, let's just say hypothetically, could take down 30 million of it. Well, we would then go out and bring in an additional 20 million of equity or investor capital to then go after that, what we see as the opportunity. So right now we're kind of in one of those situations where we're building multifamily in California, which, we talk about the housing crisis. We believe that's opened up a big opportunity to build, especially in the
That's where you
areas
want
that
to
are
be.
difficult to get through. And there's a lot of building that has stalled out. The debt markets are very challenging right now, which has made it hard for people to move forward on the opportunity. We're in a position, thankfully, where we have a big enough balance sheet and enough experience and relationships where we're getting debt that is more long term and safer in our perspective. So that looks good for us. And then you mentioned the yield part, right? When interest rates go
Yep.
up, you can capture more interest. And so we have a debt portfolio where we lend on multifamily and storage, and we're able to actually make some interest back, which is nice. And that's just a function of everything that led to that question.
Have you seen things get a little hairy in the commercial real estate? Or, I mean, you guys do more individual housing, it sounds like, or at least large complex, but for families, a lot of that stuff is not necessarily marked to market. So everyone's kind of incentivized to be like, "Oh, you don't have to go and reevaluate that. Let's take a peek at that next year because that's not going to help us. It's not going to help the investors." Do you think that's like maybe the next shoe to drop? Is that something that you could potentially be concerned about in the next 6 to 18 months?
It's a really good question. So, are there groups out there where that's the case? Probably. There's a lot of groups though, and when you start getting into the bigger groups, what they do is typically they have a third party audited financial, they have all their properties appraised each year, and we just went through an appraisal as a company. So, what I'll say about the appraisals, uh, no, they did not appraise properties this year like they did last year, right? We had a handful of storage units actually where we built them out. And typically what you do when you're trying to lease something up is you give concessions. You give a
Oh,
cheaper option for the market so that you can lease up and get to your, stabilization so that you can, that's ultimately where you want to be. And we
yeah.
had an appraiser that came in and said, we're not recognizing these as concession rates, even though we can clearly see that you are below market to lease this up. We're not valuing the property off that. So we got hit with basically discounted rents. We had basically cap rates move. So we had properties where, yeah, value went down. We had another property that we just finished an add-on to. We added 350 units on top of an existing 1,400. And
Mhm.
basically, when we went through appraisal, they recognized no value added. So that's an appraiser underwriting in an uncertain market. Um,
Wow.
on the multifamily side, you're we didn't see it as much as storage. We saw more discount on the storage side, but multifamily cap rates have moved. They're, if they were valuing a property for us at, maybe a 4.5 cap, now it's around a five and a quarter. Cap rates have moved in our area between half a percentage point and three quarters of a point. So that brings value down. So I would
Yeah.
say that is happening for most of when you start moving outside of mom and pop. Now, what are the risks or what are the challenges in multifamily? There's a handful of them. Anyone who's uh, in the middle of development, right? How it works is you typically get what's called bridge debt or short term debt. This is going to be your 3-year financing. And you basically do that, you build it, you stabilize it, which means you get to a certain percentage occupancy, and then you move in or refinance into your long-term debt, right? That's typically what people do. Well,
Is it
if you
usually the
started
same lender?
building, no, a lot of times you go to a different lender. Yeah, you
Okay, okay,
refinance out of your bridge debt and move into
okay,
like more like maybe a Freddie or Fannie
sure.
loan. And in that refi, if you underwrote the property before you built to be able to be set at a certain value today, you're not
Hmm.
at that value anymore. So basically, what that would mean in a very simplistic form is if you expected the bank to give you, let's say, $15 million when you started the project, now they're giving you six. And so a lot of times the value of the property is lower than you expected, so you don't qualify for the new loan. And if you don't, you have to recapitalize the deal. That means you have to bring more capital in. And that is not easy to do in a distressed position. So that's what they call liquidity crisis or liquidity need. You're going to see a lot of
Huh.
investors with that issue for 100%. That's going to happen. There's a lot of investors right now that are buying properties where the cap rate is lower than the interest rate. So your your negative cash flow ultimately. There's no spread between cap rate and interest rate. And a lot of them went in with the expectation that rents were going to continue to grow. And so they were going to wait it out until the property produced enough cash flow to pay the basically the debt service. That's a risk I'm not willing to take. So I think there's a potential that investors have a hard time there as well. Office space, I mean, that's going to be that's going to be a heavy one.
Yeah, yeah, that could be nasty. I don't, do you ever listen to the All In podcast?
Every once in a while, yeah, every once in a while, somebody will send me an interview or a conversation they had. Yeah,
So I do like
what
it.
did they talk about real estate and what they're expecting?
Yeah, so one of the investors, he's part of the PayPal mafia, David Sachs, and he owns a building in San Francisco. And he was just sharing on the podcast that he was asked by the bank to post some collateral because of how much the value has dropped. So his lender asked for collateral. They're like, can you maybe put part of your brokerage account or something against this property because we need something on our books.
Right.
And I was just thinking, like, that is not something that people talk about. Like, that
Yeah.
is some crazy, you know what, hitting the fan.
Yep.
And I just feel like this whole, and they kind of talk about a little bit of the mark to market stuff and how everybody's in this little hush hush phase. And that's not too dissimilar to, the private markets trying to, they're doing down rounds. You know, they raised money at 20 million valuation and now they're raising money at 15. And, the A and B rounds looking at the C rounds are going, what the hell? And
Yeah.
I think that's just kind of the environment. But I feel like that's been a little bit of the theme of our conversation today of high interest rates is just crunching things. And you even asked at the top of the call, if I felt that like all of the slush money propping markets up is a bad thing. What are the impacts long term? I do feel like we're almost getting like a little bit of a flush here, a slight like it's like the most anticipated recession that we never had.
Right.
And maybe we're not out of the woods. I feel like we've been saying that for a few like 2 years now, and here we are year to date up 15% in public markets.
Right.
And it's just like I don't know where this thing is going. All I can do is do timelines and say, okay, if I don't need the money for 10 years, I'll bet on stocks. If I need money in the next 2 years, I'm going high yield. And I just am not smart enough to do anything else.
Yeah. Yeah. That's not a bad strategy. Melissa, the name of the podcast, what's the podcast again? It's the All In podcast. It's
Yep,
four
all
of
in
them,
podcast.
four guys, right? Yeah.
Yep.
Smart. Yeah. All are smart. Um, yeah. Well, look, we're seeing the banks saying that they're lending, but their threshold on what they will lend to, you can't qualify for. Basically means they're not lending. And a lot of them are basically saying, yeah, we'll lend to you, but you need to put a certain percentage of money at our bank and then we'll lend to you.
Oh,
Basically, what that means is they're having a liquidity issue. They don't have the liquidity to cut the loans to us. So, if it's how long is it gonna last for? I think is a big part of this. The union strike I think is an interesting one. The auto strike. I think that could be, I think, massive for. I think that could be incredibly painful for us, actually. If they don't figure that out soon, we're talking about like more supply issues, especially the car market. Like I saw not too long ago, the average car sales now like 48 grand, something ridiculous.
wow.
I know.
Yeah, that could be the first crack in the system because it does feel like we're walking on thin ice. I mean, I would probably argue that the UK is already in a recession, Germany's in a recession, Japan's probably in a recession
Right.
by the two-quarter definition.
Right.
And it's, I feel like we're just like a couple cracks away. And the longer that we keep these interest rates high, the thinner the ice gets. And we just keep on walking across the ice.
So let me ask you this, because you brought up the what you like is savers being able to actually make money right now, right? So I guess my question to you is, in moments that are deflationary, what
Yeah.
it seems like the Fed does is they print money so that it's an inflationary move during a deflationary time. Do you think we should go through those cycles and actually allow it to be deflationary? Or do you kind of think it's actually healthy for us to stick to the, let's say, targeted 2% inflation because it ultimately incentivizes people to get money into the economy and stimulates it and grows it, et cetera?
That's really tough. I think it's kind of how, yeah, exactly. The most impossible question to answer. But I would love to see us try to out earn our problems. I do kind of land in the camp of innovation. And when you just look around, like the world is getting weird, it's changing. Like I run my entire company completely virtual with one other dude. And when I left the old broker dealers back in 2018, we had a team of like 8 and I'm doing more revenue than we were doing with that team. And it is just like completely automated. I mean, I have Zapier pushing stuff. I have ChatGPT open all day long, helping me write my emails. Like we are just in a different world
Right.
and it's freaking exciting. Like I have not, I'm young, so I like wasn't around in the dot-com bubble or anything like that. But like just a lot of people I feel like are kind of like feeling like we're in that era. And I feel like if you're, focused on maybe the real estate side, it could be a little scarier. But if you're kind of focused on the tech side, I feel like it's pretty exciting. And I'm just glad that we have everybody supporting each other and we need every aspect of the market. But to answer your question though, on like interest rates, I think you kind of have to choose like which one sucks less.
Right.
And I feel like probably printing money, I think we've gone too far with it, but historically that would have been probably my vote. I think probably moving forward, one of my more important ballot issues is going to be fiscal responsibility. Now, with that being said, though, we're at 130% GDP, to debt ratio. Like that's very bad, but like compared to who? We're kind of still the shining economy on the hill here, compared to pretty much everyone else. So like, does it look bad? Yes, it's looking bad, but holy smokes, would I rather be us than the other guys? So I don't know. I still land on the side of probably would prefer a little bit more libertarian, like let things fail a little bit more, let things get a little bit worse. It wouldn't be probably terrible if we got to 6% unemployment. I hate to say that out loud, but like, I don't know. Like, I'm probably in that camp, just a fuzz more.
Yeah. Yeah. Yep. Okay. So then 2008, are we bailing out the banks? Are we letting the system freaking destruct and rebuild?
I'm not smart enough to answer that. I don't know the intricacies as well on that. I mean, I definitely have done my homework on it, but like Gosh, that is more of a systemic thing that I feel like we had our blinders on and we kind of allowed that to happen. So I do think that a lot of the reform that's happened could be different because like even with Silicon Valley Bank going under, First Republic going under, what was one more, maybe Credit Suisse, I don't know. That was very different. That was very, very different than banks going under in 2008. That was a totally different problem.
Yeah.
So I do feel like we did kind of learn from that mistake, which I don't think we're very good at doing. So I do feel like we have gotten a little stronger. And I honestly think that like the UK and even Canada, they're going through a rougher patch because they're way more on the variable rates.
Right.
There's a lot of people that are about to get hurt in those markets. You probably know way better than I do, but
Yeah.
um, I would say that we can't let systems fail. I also do appreciate that we did bail out Silicon Valley Bank, even though bailout is probably not the right term because they used the bank insurance money for that. But what I think is really, really dumb is that our system allows for banks to go and get really risky with our dollars that are deposited there. And like that, it's not possible for Mikey or Colin or anyone on this call to understand the credit stability of a national bank, a regional bank, a credit union. So I think that was some really bad risk management done on those banks. I'm really glad that we immediately said we're going to make every depositor whole, because if we didn't do that, we would be incentivizing people that F the bank, I'm just going to keep my cash under my mattress. And that is not a safe system. So I do feel that we need to, I hate having the too big to fail thing, but I almost think that banks need to be kind of reeled in a little bit if we want them to be used as a monetary, almost like a utility. It's almost like, our energy bill, right? Like we can't have banks failing and creditors losing their money because they didn't do their due diligence on their effing bank account. Like that cannot happen.
Yeah. 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 Yeah.
Like
I
that's
mean,
crazy if we can trust banks. That's not
yeah.
good.
Yeah. I agree. Yeah. That'd be bad. I
Mike,
agree.
we got a
I agree.
question for you. Because this, I feel like you would be like a really fun, and this is not solicitation, I'm just phrasing it from a question standpoint. How do you think about your investing, wealth building, and like diversifying between putting more money into the company? Like, are you maxing out a 401k, or like, do you like take your earnings and then try to go buy like your own personal portfolio of real estate, or is all of your real estate tied up within the company and you're just kind of becoming a larger um, equity owner? I don't know how you guys are set up exactly, but kind of how do you think about like putting all of your eggs in one basket, but the returns are probably super juicy
Yep.
compared
Yep.
to, just the boring index funds? Like what's your thought on
Yeah.
that?
It's a really good question. So how I've invested has changed over the last 20 years. When I first started investing, probably the first decade, it was very conventional and very hands off. I was putting the majority of, I had a 401k, said Roth IRA. I, put post-tax dollars in the stock market, as bonds. I was diversified. I was doing the
Smart,
the
straightforward.
the normal outlook, right? I started investing in storage units. And how I basically was looking at it back then was basically I wanted my real estate portfolio to land somewhere between 10 to 20%, but the majority of my money was still in, retirement accounts, the stock market, stuff that was more liquid or that I could actually pull my money out of. Everything changed when I started my first business. That's where the outlook switched up. I
Okay.
started my first business. We ended up selling the business, and I had a huge windfall of money.
Was it
And
marketing? Were you doing a marketing
we started a
company or
craft,
what?
a
What?
craft, a craft brewery.
That's right. That's right. Okay.
Yeah.
I remember stalking you at one point and remember being like, what? That is so cool.
Yeah, we sold our company and we did very well with it. And that's when it all changed, right? One, I had more money to put into, things like real estate, but and even the market, but my outlook on my greatest return had changed. I was no longer looking at it through the lens of I'm making money as a pro skateboarder and I'm putting as much as I can into passive vehicles. I now went in and looked at, okay, I have the ability to make more money myself in my companies than anyone else is ever going to make for me. But, and like you kind of talked about, there's a balance there that's very challenging for entrepreneurs because typically we put everything in our company and there is no diversification. I'll tell you where I'm at with it, right? I don't build out my own real estate portfolio only because I have a company of 20 employees that manage real estate 24/7. I'd rather invest passively in the projects that our company is doing and have my business manage them for me, as opposed to me having to go create a second company ultimately. How I
Can you
invest
give us an
in
example?
what's that?
Can you give an example of that?
Yeah, so basically, let's say we have a new project that we're going to close on, right?
Yeah.
When you close on a property, you have basically a GP and an LP structure. You have your general partners and your limited partners. The general partners are typically the active partners in the deal. So usually my company would be the general partner. Our investors who are passively would be the limited partners.
Like
What
if
I
my
would rather
clients
do,
wrote you money.
yes, exactly. So what I typically do is put my money passively as an LP, and I have my ownership in the company that takes a percentage of the GP. Does that make sense?
Okay.
I participate passively and actively. So if you looked at my net worth, and now we're going into like, my actual structure. A percentage of my net worth is valued based on my equity share of my business. And then I have a whole other part of my net worth that's valued based on the shares of the real estate that I own passively with all the other investors, not my business partners. Does that make sense? And so
Yeah, sometime.
my outlook is okay, let's say I've got, I don't know, pick a number, $100,000. I got 100K that, I want to go look and buy a $300,000 property. Well, for me, I'd rather put that 100K passively into a new project we're going to do and have my company basically manage the new project with all of our investors coming in, as opposed to me going and, doing my own property, getting a property manager, overseeing the property manager, etc. So I'd rather just have my in-house team do it for me.
As
Uh,
a founder and CEO, how do you think about like, and maybe I'm cutting you off too early because I am curious about the others. Actually, I'm going to pause. Sorry. Keep going. Keep going.
what I think you're going to say, I think, and if not, add to it, is then I have the dynamic of, the money I have. If you look at my total portfolio, I am very, very, I'm heavy in real estate. My portfolio is very basic, but for a financial advisor, they would look at my portfolio and go, "Whoa, dude, you have way too many alternatives, or too much real estate here." I own a lot of real estate. I have money in startups that I'm investing in other people's companies. I have money in the stock market. I still have, my Roth IRA and 401k that I, started when I was a kid, but I don't fund those anymore. We can talk about that after. And then I have my
Yeah.
business. And so right now, all of my money that I'm making, or if I have a year where there's a dividend, I'm typically putting it into the business right now. That's more a function of us currently actively building our business. Once we get past that stage, I'll probably look and get back to what was more of a passive investment strategy. But right now, the majority is going into my business.
What do you think about this definition of financial freedom and independence as a business owner? When I think about financial freedom, like a lot of people are like, oh, start a business, like let's say you're, like what is the ultimate wealth building or passive income machine. And I have a lot of clients that own real estate and they own properties, but you still need things to happen. Like you still have to have tenants paying on time. You have to have the place not burned down and things have to be operationally sound. That gives me a little bit of goosebumps. It even gives me goosebumps like if I brought on partners and sold my practice and then I just started kind of going into the background and maybe someday I'm a 10% owner of my practice and there's 5 other advisors and I just collect my K1 every year in a small salary or something, and that's my financial freedom. But those guys could still sink the ship. You know, they could do something wrong, blah, blah, blah. Like there still is that risk. Now, the only way, in my opinion, to eliminate that like idiosyncratic risk like that and just make it more systematic, it's just really eliminate it entirely, in my opinion. I think you could almost say that, is to own 10,000 companies via an index fund. And then you now literally have your chips all literally on every single page on the board. And it's like, oh, are we going to have electric cars? Yeah, great. I own Tesla. Are we going to own, did Tesla not win? Oh, it's going to be GE and Ford. No one saw that coming. Everyone thinks they're dead companies standing. Well, you own that too. Oh, did those companies get bought out by Tesla? Oh, that you still win from that. Is oil going to win? Is whatever going to win? The point is that you are so diversified. Like that, in my opinion, the only way you lose your money is if the world doesn't exist as we know it today. And the only way to hedge that is probably plant your own corn. And like historically, you can pretty much withdraw like 4 to 5% per year and never run out of money. And actually, in fact, most people, if you do withdraw around 4 to 5% per year, end up with like substantially more than you started with.
Right.
And now you can just pass that wealth building machine on to your kids, and pretty much nobody can F this up.
Yeah, that's right. I mean, I share this similar view that I've had forever. I've always tried to target that 4 to 5% number. That's kind of been in my perspective, something that you consistently can count upon even during market corrections, right? Now, how you get there, and you're talking about diversification and tracking the index as opposed to going in on one asset. Totally get it. I would say I think it's going to be more personal. Like and what I'll say this, like what is the goal of financial freedom for most people? And to keep it simple, it's interest coming in that you don't have to sacrifice your time for, right? Once you have enough interest to cover your expenses, you have the choice to work or not. For me personally, I don't think I'm ever going to exercise that option. I have a very strong feeling that 1, I'm going to work forever. And 2, I'm not totally sure we're called to retire. I know I'm still wrestling with that in my mind, but I'm not sold that we're supposed to basically check out and go golf every day and not be productive. So just know that I'm wrestling with that one. When it comes
my definition is also make work become recreational.
Yeah, fair. Totally fair. Yeah, that's okay. Yeah, I agree with that. What you put your money into to feel comfortable that let's call it 4 or 5% is possible. I think you could actually do it in a lot of ways. If you're looking at real estate, for example, just because that's my industry, so I can speak the most on that. If you're not getting very creative with debt, real estate is very, very boring and basic. You're not supposed to say this, but whatever. It's kind of a bond alternative in a lot of ways. I know that's like not the right thing to say, but like, you buy something at a 7 cap rate with no debt. Okay, a lot has to go more of an Armageddon style for you not to pick off that 4%. For me, look, there is a good chance with what I'm doing that if things go wrong, I will lose a lot of money because I have so much in my business. I'm off-weighted there. But my challenge is I'm an entrepreneur. Like we create things and I feel comfortable with risk when I'm controlling it, even though something can go wrong, right? I think the hedge there is this time I'm building a private equity real estate firm. So the asset that is creating the revenue for the business is a risk adverse asset. Creating beer, that's a different story. Like, you know what I'm saying? Much more risk with trying to create a craft brewery than a private equity real estate firm. Um,
Preferences change faster with beer than real estate.
yeah, but the big but is, for our investors, we gave them a 12x multiple in 3 years. I can't do that in real estate. I will never be able to do that in real estate.
That
So
is cool. That's pretty dope.
yeah, yeah, it was epic. So it's like but there was a risk tied to it, right? And that's something that we said to all our investors, like, give us the money that you are totally comfortable losing because there's a chance we lose it. Uh, but on the flip side, if you gave us $100,000 investment, we gave you 1.2 million bucks back in 3 years. Like that's the risk return profile. For context now, we typically target a 15% net return. So we're doubling money every 5 years as opposed to 12xing it in three. You
Yeah,
know?
yeah, completely different. And that's still actually outperforming the market historically. So, um, I
Yeah, and
mean,
it, we just
at
we,
least
most people, I would say most of our investors look at real estate as a diversifier, right? They
yeah.
typically hold somewhere between 10 to 20% of their portfolio in real estate. I would say that the average is actually closer to 10. And they still have the majority of their money in the market, and they follow more of a traditional outlook. They just have a percentage dedicated to real estate as a diversifier. That's a little bit different than me, but out of our 500 investors, that's definitely the norm.
Gotcha. Man, that's awesome. I really appreciate you sharing, and I hope that my question didn't come across as like
No, no,
damning
no.
to your style.
No,
Like,
no, no, no. I love that. Yeah, I love that. I was actually watching Graham Stephan on who's the auditor YouTuber. You know what I'm talking about?
CPA?
There's a YouTuber. He's got a huge channel. I guess I hadn't heard of him. He audits people like their finances.
Oh no, that's awesome. I need to get on. I'm
So,
sure I've
dude,
seen him.
I watched this video yesterday. Graham Stephan was invited onto his show to audit him, right? And it was so fascinating to watch. And he does like a a reaction to his video with him, right? And he's just talking about how
Yeah.
uncomfortable it was. He's like, dude, I was like kind of like giving my opinion on things he's doing. And what I don't know Graham, but what it seems like he's very non-confrontational and like, gets a little bit uncomfortable in those positions. And you saw that. But no, look, like I would say one, no, I didn't take it that way at all. Two, I appreciate the
Yeah.
question because I think this is valuable for anyone listening. And three, and to really drive it home, uh, where you get in trouble is when you don't understand the risk and you're not comfortable with the outcome of what that risk can create. For me,
Yeah.
I'm comfortable with the risk I'm taking, but I am very aware of what happens in that scenario, And also, I'm at a point where, yeah, I can't take as much risk today as I could 10 years ago. I'm married, have 4 kids, but uh, you only have so many opportunities to build new things. And so, maybe 10 years from now, the next company I start will be, I don't know, maybe it'll be different. I will see. I don't know. But right now, we're going for it.
My first baby's due November 19.
Oh, congrats,
Um,
dude. Congrats.
and what do I need to get prepped for?
Are you having a boy or a girl?
We're having a girl.
Oh yeah, you are screwed. Okay,
I'm,
basically, this is what's going to happen.
I'm
The
so scared.
girls, the girls,
Really
they
excited.
they steal your heart. You need to be prepared for it. The girls, the daddy daughter relationship is very real. It's very special, and they will learn very quickly how to tug on your heartstrings to get what they want. Right? Just know that. I would say as you go through this is what I experienced with the first one, and then if you have more, it in some ways gets easier after this, but you're going to have 3 weeks of devastation. Your world is going to feel like it's been flipped upside down. And if you're like me, about a week into it, I was sitting at the top of the stairs at 3 in the morning crying, going, I ruined my life, right? It is so shocking to the system at the beginning. And then you hit 3 weeks and it changes. And all of a sudden you can breathe a little bit. And then you have
Yeah.
another basically 3-month window. and you're going through trials and it's tough. And then after 3 months, you basically can get to a year and you start feeling more and more confident in yourself, right? Here's what you need to hang on to. This is the number one thing. Everything happens in a season. It's not forever. So right when something happens where you feel like you're never going to be able to get out of this stage and you're almost at your max with it, it changes. And it's comforting that it's not forever. So don't get frustrated that it's challenging. It will get easier. And then the 3 weeks, 3 months, and then about a year, that's like your view on what you're looking forward to.
Thank you so much, man.
And then
are there any?
it's amazing, bro. Like you're going to change a lot, and your daughter is actually going to highlight weaknesses in you that will be an opportunity for you to improve upon. Like the kids, they don't listen to a thing you say, they watch everything you do. So things are caught, not taught. And so you're going to have to really be mindful of the example you're leading by. And it's not long before they start picking up on the things we don't do well.
Incredible
Yeah.
advice.
But it's sick,
and
man. You're gonna love it. It's really, really cool. It's the most rewarding thing ever. I think it's it's a blessing. It is a huge, huge blessing.
We're ecstatic, and we're super fortunate that our families are supportive. And my sister just had a baby earlier this year, and so did my wife's sister. So it is just like baby season, and we're anxious now. We're just excited.
Good. I'm stoked for you, man. That's awesome.
Mikey, I'd be remiss if I didn't at least shoot my shot. We got to get your 401k at the company set up at some point so you can start deferring some of your income at this high income tax bracket.
I love it. This is what we're gonna do. Hit me. I want to get connected with you offline as well. So shoot me your contact after this so we can keep in touch. And I'm out by you all the time. We actually have a property pretty close to you. And so I'll hit you up next time I'm down there, which is probably going to be in the next 4 weeks.
Nice. Just because you're 20 employees, we got to get that tax saving. Right now, you're Uncle Sam's best friend. So if your effective tax rate is in that 45-50% range, which a lot of my clients are, man, you're making like 25% right off the bat, just putting, 22,500 into that 401k. You could do it for your wife. We could set up for the kids, whatever. So, hey, just had to shoot my shot here.
I love that. Look, I'll tell you what I'm wanting to do with the kids. And I think we'll probably start doing this first quarter of next year. I want to start using them in the business. I want to not using them in that type of way, but like creating content with them and having them be a part of it in a way that would justify us paying them. And then, go through some of the benefits of that. Yeah, that's right.
Yeah. No reason not to. I mean, the system's set up that way and you might as well take advantage of it.
That's right. All right, big dog, dude, it was a blast. I've got to go run to a dinner that I have at 5. Thank you, everybody, for joining us. Hey, send me your contact so we can keep in touch, and then I'll hit you when I get home.
All right. Sounds good, Mikey. Great talking with you. Appreciate all the conversation and advice.
Later, Colin. I'll talk soon. Later, everybody.